We are witnessing a series of shocking changes to the housing market that you simply cannot ignore. From rising inventory and builder incentives to the talk of 50-year mortgages, the market is shifting. But the most significant change, Fannie Mae is eliminating the need for a minimum credit score. What do these three major shifts mean for you? And more importantly, what do they mean for the future of home prices? Let's jump into the fundamentals right now. Fannie Mae. That's the Goliath that buys your mortgage from your bank and then sells it as complex investments to Wall Street. They are the engine keeping the entire mortgage industry running, and their eligibility rules are undergoing an unprecedented, massive shift starting November 16th. This is big. The credit score game changer, check this out. Fannie Mae is scrapping the minimum credit score requirement for their whole desktop underwriter DU system, the 620 minimum score. It's toast. It doesn't mean credit checks are gone. It means underwriting is shifting from a cold, automatic algorithm to a comprehensive, human-reviewed process that looks at your whole financial picture, for real. If you're self-employed, if you've had a credit bruise due to a short-term job loss, or if you were previously declined just for a low score, this could be your way. And this is a massive expansion of the qualified buyer pool. Translation: more competition. The medical debt boost, the unfair score eraser. And get this, as of early 2025, medical bills can't even show up on your credit report for lending purposes. This is expected to raise the credit score of millions of Americans by an average of 20 points, clearing yet another huge barrier to getting a mortgage. These changes are designed to get more people into homes, and that leads to one absolute certainty: increased demand. Watch out. The government is currently pushing the idea of a 50-year mortgage. For real. Why? They want to lower the monthly payment and make these insane home prices look more affordable. The math is mad. Spreading a loan over 50 years barely even lowers the payment compared to a 30-year term, and it'll hit you with a higher interest rate because the bank is on the hook for longer. The long-term cost is dramatically higher. You could pay nearly double the interest. That's wild. The buyer trap is real. This is not a win for your long-term wealth period. Equity accumulation becomes painfully slow. After 10 years, a 50-year loan borrower has a fraction of the equity of a 30-year borrower. You're basically renting from the bank. The real impact is price hikes. The goal is simple: get more people buying ASAP. If 50-year loans drop, more people qualify, and the value of anything, including houses, skyrockets when demand increases. The only true long-term effect of 50-year loans will be driving home prices higher. It's a structural barrier to wealth. So, what do these demand-increasing policies mean for the current market dynamic? Days on market are ticking up, and inventory is higher. Listen up, fam. This is giving buyers a small window of opportunity right now. Opportunity 1, scooping up foreclosures. Affordable homes still exist. You gotta look for foreclosures and watch the price drops like a hawk. When days on market go up, prices come down. A house that was $199,000 last week might be $184,900 today. You need to be ready to strike when that price dips. Don't sleep on it. Opportunity 2, the builder hustle. New construction is up, and builders are straight up desperate to move inventory. Always ask them, no cap, are you paying closing costs? And more importantly, are you buying down the rate? Many builders are offering multi-year rate buydowns that can drop your initial rate significantly, like 1.9% in the first year. That's a steal. The timeless investing rule. Stop waiting. Is now a good time to buy? Look, there is never a bad time to buy if your finances are squared away. Your principal and interest payment is fixed for the life of the loan. You are gaining equity through debt paydown and value appreciation. The key is, you gotta act when you are ready. Finally, we need to address the real reason prices are where they are. It's not the seller, it's the buyer. Straight up. For 13 years, mortgage rates were kept too low. For too long, a home is only worth what a buyer is willing to pay. Buyers were snatching up houses at those prices, and that's what drove values up. Now, the median age of a first-time home buyer is 40, the oldest in 45 years. Think about that. Is it just consumer debt? The lack of financial education? Nah. The core issue is that affordability has been eroded by a decade of low rates combined with massive new demand drivers like these policy changes. The message is crystal clear. These changes will open the floodgates to new demand. You gotta understand the fundamentals and act decisively. Don't wait. If you found this breakdown valuable, hit that thumbs up and smash that subscribe button to grow wealth together for more financial clarity. Tell me in the comments, what's your take? Do you think eliminating the credit score minimum is actually a good thing for the housing market?